Should I sell my BND and move into CDs? All right. So my man emails me that, and I got another question on BND as well today. So very interesting. So here's what I ask people when they're investing. How do you make money investing? Okay. Two dogs just came down the stairs. You buy low and sell high, right? All right. You buy low and sell high. Is BND trading at high or trading at low? Well, over the last 3 years, BND is down about 20%. All right, so since 2021, 22, now 23. Yeah, it's down about 20% or so. So if he sold BND, we'd be doing what? We'd be selling low. Do we want to sell low? No, not necessarily. The only reason you want to sell low is if you think it has lower to go. All right, so we're like, man, BND's got lower to go. So why would BND, again, BND is the Vanguard total bond market fund, by the way. About 70% of BND is government debt and agencies, just FYI. I don't know if you knew that or not. 30% is corporations, 70% is government debt and government bonds and government agencies like Ginnie Mae and things of that nature. So very, very safe in terms of his ability. What are you doing, guy? He's over there sniffing around. Oh boy, now he's got a toy. That's not really a toy for him. Knucklehead, but he is so doggone cute. Let's see something funny. This guy. What's he up to? Can you see him? We got him. Hi, guy. What you got there in your paws? Yeah. Is that something for you? Is that something for me? Yeah. Oh, boy. Hi, Finnegan. Want to say hi to everybody? Finnegan. So cute. Papa just went upstairs because he heard my wife open up the... There he goes. There he is. He heard my wife... hi, baby. He heard my wife open up the fridge. Oh, so cute. Oh, man, it's a dog's world. We're just part of it. Anyway, so BND, you'd expect, so that's the total bond index. It covers, like I said, it's a heavily government bond fund. So BND, the only reason you sell is because you expect it to go lower. So then you say, well, what would cause it to go lower? And you have to answer that question. What causes the bonds to go lower? Well, when interest rates go high. Right, so now we're sitting here thinking, all right, we went from basically 0 to 5.5 over the last 18 months. And the BND has been knocked down 20%. What's the likelihood we go from 5.5 to 7 to 8 to 9? It might go from 5.5 to 6. But what's the likelihood it goes even higher than that? I don't think very high. The economy is not in a good place, man. I talk to people all the time getting laid off. The departments of big companies getting laid off. Retailers are having a hard time. The cost to hire people are going through the roof, and on top of that, not selling as much. The Bojaden economy is on its back. That's just a fact, man. It's just a fact. There's just no other way around it. I mean, you can see it. Just talk to just talk to your neighbors, and I guarantee they'll tell you. If you're already retired, just talk to your neighbors who aren't. Say, are you doing pretty good out there? And they're gonna say no. So they might raise a little bit more, but that's going to be it. And so when it I mean, I could be wrong, I don't know, but when it levels off, what happens? Then the price decline will stop. All right. Also, what happens? Well, if you look at the history of bonds, and I think Blanchett or was maybe Wade Pfau, I can't remember, but one of those gents, financial planning gurus, did a study on this like 10 years ago or something like that. And I forgot what newspaper, my Journal of Financial Planning or something like that. They showed that the current yield of your bond is the rate of return you're going to get over the next 10 years with like a 90 to 95% certainty, if that makes sense. So if you're getting 4.89% on BND, which we are now, there's like a 90 to 95% assurance that that's what you're going to get over the next 5 to 10 years. It's just that simple. Now, it could be a little bit off. In fact, if you look, I just looked on if we look at, check this out. If you look at so here's 4.89 is the current yield on total bond index. But if you look at this guy right here, we'll go back 10 years so that'd be 2014. We'll go back to 2014 on Treasury yields. You can pop up there barking. Let's see here. We can see, it's going to do it for me, that 7-year bonds are about 2.41 in 2014. So let's see what BND has done over 10 years. In 10 years, we've done 1.11. So we haven't kept up with the interest rates that we've had. And that's the reason for that is because we've had such a bad run here in the last couple of years. But be it as it may, we've actually done significantly worse on a return as the 7-year bond was doing 10 years ago. And that's what we call the on the bell curve, the outlier here, if that makes sense. I don't say black swan, but along those lines. Is that likely to happen again? I think it's likely to happen the other way, frankly, where you're going to get a better rate of return than what the current yield is. But I don't know that for sure. And the reason I say you're going to probably get a better rate of return, let me show you. So I'm working on, this is one of the things for my course I'm doing, just kind of give you a cheat sheet of my course. So what happens here is we have your yield equals your coupon over the price. I'm not going to get into this too deep here just because this is for my course, all right? And if we have a current yield of 6%, let's just say we have a current yield, we can kind of figure out what the price would be when rates go up, rates go down. Long story short here, if we had a yield of 5% and then the rates go up to 6%, the price of this bond would drop to 83.3 because price equals coupons over yield, yield equals coupon over price. I'm not going to get to that here because this is for my course. But again, we have a 5% bond, right? It's trading at a par of 100. Their interest rates go up to 6%. That means the price has to go down to 80. It doesn't have to, but it should go to 83.3. Right, and you can see that. So basically, this is what's happened now. The BND has dropped because interest rates have gone up so much. 83.3. Where's BND going to mature though? Right? The bonds inside BND trading right now at 83. What price do they mature at? They mature at 100. They mature at 100. All right, so that's how what's going to happen here. We're going to have these bonds. They're going to start creeping back up as the years get older, closer and closer to the par value at 100. So there is some capital appreciation in there as well. And I don't know how much that's going to be reflected. In terms of can you bank that? I don't know, man. But I do know government bonds don't go bankrupt. Government bonds will issue their interest rates. So we're going to have capital. And that is, by the way, that's reflected in the current yield too. Right here. Yield is coupon over price, price is coupon over yield. So, these things are all reflective. All right, that's just fact. So the 4.89 isn't simply just the yield on the bonds or the coupon that you have in the bonds, but it's also the price being discounted. That's what makes the bonds so attractive to me, because the price is so discounted, it raises the yield. It's just like it's like dividend. The higher the price, the lower the dividend yield. The lower the price, the higher the dividend yield. Same thing with bonds. The lower the price, the higher the coupon. Not the coupon, the higher their current yield. The lower the price, the lower the current yield. So it's like a seesaw. But the thing with a bond, unlike a dividend stock, is that it has to always go to equilibrium. The bond will always go to maturity at 100. So if you're going to sell the only reason you sell your bonds is because you think the CDs will give you the reprieve from a downside risk. But I'm like, okay, maybe. How much more risk is there? That could be wrong. We could go to 10%. I don't know. I absolutely don't think so. We could. I think that'd be crazy. And then I'd be wrong. I say, oh man. But to go to 10%, think about this, my friends. To go from basically 1 to 5 is the equivalent of going from 5 to 25. You realize that, right? So 1 to 5 is 1 to 2, 2 to 3, 3 to 4, 4 to 5, 5 to 10, 5 to 15, or 10 to 15, 15 to 20, 20 to 25. I think, is that right? Yeah, I think so. It's a factor of 5. Yes, it is. So to go to go to the equivalent of 1 to 5 is the same thing as going from 5 to 25. We're not going to 25%. It's just not happening. It's not happening. So as such, we're like, okay, so what is the ultimate downside risk in bonds? It's pretty much over, in my opinion. I just loaded up. I bought a couple, what did I buy, 50 or 100 more shares of, I can't remember, EDV. Yeah, I've been killed in that fund this year. I missed last year. We got smoked. EDV is down 51% so far in the last 3 years. 51%. That's almost as bad as what happened in 2008 for stocks from 2007 October to March 9th of 2009. 57%. Why am I loading up on it? Because it's inevitable that those bonds are going to mature at par. I'm going to get a guaranteed government interest payment on the coupon. And when they mature at par, they're going to go from here to there. Right now, my EDV, I'm getting 5.07. I'm like, I'll sit tight, 5.07. I'll sit tight in that. Just sit there, sit there. The only thing that could hurt me is if rates keep going up. That might happen for a little bit, but I expect by the end of this year they'll stop. And then I think I'll have some serious potential for appreciation. I could be wrong. But again, you don't sell low and buy high. You sell high and buy low. The only reason you would sell right now is because you think there's going to be significant more downside risk. A little bit of 2% downside risk, 3% downside risk, that's not a time to sell or reason to sell. You have to say, I think I'm going to lose another 10%. You say, okay, so we went from 1 to 5 and you lost 14%. To lose another 10%, we'd have to go from 5 to 22? I just don't see that happening. So I would not recommend that. But, you got to do what you got to do. It's your money. No one cares about your money more than you. I wouldn't mess with that. I'd be like, no, leave it well enough alone. I'm getting 4.89 right now, whatever I'm getting in my yield, just clock that. As that money keeps in, and bond mutual fund or ETF, I can reinvest it. When the price is low, I think it's a winning solution for sure. All right, love your thoughts. We'll see you